You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. So be sure to check out our live stream via the Mixlr app, or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. Learn more about QuickStrike at BANTIX.com. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. Visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music can mean only one thing. That means it is time for TWIFO, This Week in Futures Options, a program where we pretty much break it all down on the other side of the fence. So you want some crude? Probably got you covered. Gold? Probably got you covered there too. Maybe some equities? Got you covered there. Who knows what else? Ags, euro dollars, you never know what the heck's going to make it. Lean hogs. Got to tune in every week. That's why we do the show. My name is Mark Longo, and I'm joined by a cavalcade of characters, including, I am pleased to say, the return of the most beloved curmudgeon in the history of futures options. Yes, you know him, you love him, most of you anyway. Mr. Nick Howard, the founder of BANTIX Technologies, creator of a little app we like to use around here called QuickStrike. Mr. Nick, welcome back to the show. It's been too long, sir.
Yeah, I had to take a European vacation. I took 5 or 6 weeks off while everybody's home. I feel good, ready to go. Got a good lineup today, so let's have at it.
We do have a good lineup. We are also joined today, I should say first off, our old buddy, Mr. Sean Smith, traveling hither and yon, not joining me in the studio today for Delicious Burgers, but he promises, he swears, he will be back next week. So Delicious Burgers postponed for another week, listeners. But we are joined by a great guest holding down the CME Group hot seat this week. He is Adam Webb, the founder over there at Macrohedged. Adam, welcome to the program.
Hi, thanks very much. Thanks for having me.
All right, and Adam, as we are wont to do with all of our first-timers here on the network, why don't you go ahead, give us a little bit of an overview of your background in the futures options world, as well as what the heck you guys do over there at Macrohedged.
Sure. I've been around since the late 90s, so I'm giving away my age now. I was at Goldman's from 94 through to 2002. I've been market making on the Merc since 2004, mainly crude, energy products. Dabbled into the ES now and again, but I avoid that at all costs. And I'm also co-founder of Macrohedged. We set that up about 7-8 months ago, and that's really to help retail and home professional traders start to see what institutional flow is like, and also start to bring in some more of the trading strategies that the institutional guys are using, and let them get involved in that as well. So everything we do is on the Merc, and I've been, for my sins, been quoting Crude as an options market maker for longer than I can care to remember.
Well, since you hang your hat in Crude day to day, I think it's only appropriate that we start there, sir. Let's kick it off in the land of Crude here. It's been an interesting week, looking back. By the way, listeners, you guys can play along with the home game. CMEgroup.com/TWIFO, TWIFO. That's where you go to get the introductory version of the TWIFO tools. Nick, if they want to get the full kit and caboodle, where should they go, sir?
Well, we have a standalone version of this weekend options tool that you can find at apps.quickstrike.net, quickstrike with no C, and there you can get a full-on version all by itself and for a pretty reasonable fee annually. So definitely take a look at that. That's the starting point if TWIFO is your preferred tool to catch up and see what's going on in the market, get vols and volume history and all that kind of good stuff.
All that good stuff. So TWIFO is kind of like your gateway drug. You come on in, you learn, and then all of a sudden you say, hey, I need more of this. Then you head on over to all Nick's good stuff over there in the land of Quick Strike and BANTIX. But we're starting off in Crude land today, and it was, like I said, an interesting week or so. We had Russell on not too long ago talking about all things with the Crude Skew. We'll get into that again in a little bit, a bit of a contentious issue these days. But coming into this week, it seems like nothing. I mean, we're up slightly on the week, up about half a handle, right around 56 and a quarter or so in WTI coming into showtime. But it seems like nothing can really maintain that upward momentum. We're seizing tankers. We're getting tankers back. We're shooting down drones. There's this, there's that. There was a surprise drawdown, 11 million barrel drawdown in U.S. supplies. None of that really seemed to materialize in any sort of really sustained upside. The broad macro concerns about trade wars and demand seem to really be trumping anything. We got a storm coming in, all of that. None of that really seems to matter in the long term. I guess since you're our crude guy, Adam, we'll start with you. First off, is that your take? Is that kind of what you're seeing out there in the markets as well? As it's hard to really maintain a lift? And then, let's break down what's been lighting up your tape over there in the crude market making world of late, sir.
I think, yeah, you're right. The stagnating demand is really the kind of the key message. I mean, everyone seems to be looking for opportunities to sell into any upside noise. So, like you just said, drones getting shot out of the sky, tankers getting seized, just seem to be great fade opportunities. So they just seem to be kind of great fade opportunities. And I think the big factor here is that, we're seeing consumption fade in the top 15 consuming countries, over the last 3 months, the fastest decline, 2.2%. That's the fastest decline since the 2008-9 recession, the global financial crisis. And it's interesting that, every rally, all I see is just demand for downside. But I guess one of the interesting trades that we've seen, I don't know how far you guys like to go out, but certainly a trade that's been an interesting bend in the term structure has been the December 2020 is just getting crushed. It's getting crushed with the guys on OTC and Clearport. It's starting to spill over into Globex. And that's all the at the money's there, and anything 35 deltas up is getting crushed, and that's quite interesting. So it's either people buying, they're getting lifted on these front sides, and they're covering themselves. But I think that's been an interesting contrarian view that if we go lower, vol will tick up. But that's been an interesting piece that's gone through. I think there's a few thousand gone through, which for that backdate in this contract is quite a lot. I think 1,700 alone went through today on Clearport.
Yeah. So Adam, on something like the 2020 contract, when do you put markets out there, or do you mostly rely on RFQ for something that goes on a year and a half in advance?
It comes obviously the brokers out there on the OTC side that they'll work the client demand and they'll gather everyone's prices up. You get a little bit of cover. What tends to happen, one of the things that's quite nice about crude is we're very, what I call quite strike rich. we've got loads and loads of strikes everywhere that we can cover. Unlike things like natural gas, that it'll jump 6.5 deltas per strike. We don't have that. So people will blend it a little bit more. They'll blend it across the skew. They'll if they're getting smashed in the at the monies, they might go 45s, 40s, and they can kind of cover. So you get a lot of volume that's hidden in crude that gets blended across the skew. But yes, to answer your question, that the big stuff tends to go OTC blocks, and then it will kind of filter onto Globex. Some of that's hit Globex today. I checked out the volume when I was just writing some notes up. I checked out the volume, and those they've already hit today. There's kind of 1,800 gone through, and that's quite a chunk already. But on the flip side of that, it's coming back, and you look at the TWIFO report. The 70 calls is the most active in the strike. Yeah, the 54s have been crushed.
Yeah, it's fascinating to watch. You're right, 'cause I see all that stuff. Nick doesn't, because he doesn't hit select all. When I go into TWIFO, I hit select all expiration, so I see all of that good stuff. This is an ongoing debate Nick and I have about the proper way to utilize.
To be honest with you, Mark, there's Nick and I have this ongoing debate about volume in options absolutely constantly. It's I don't think 48 hours go by without us having either an argument or a debate about it. And so yes, we need to get him to certainly click on more strikes and look at it. And I need to become. I think for me, so much can be hidden in the volume, and I think especially with crude, but then you'll go and look at other things like gold, like those 1450 calls. We're getting absolutely butchered. Everybody wanted them. People were getting paid up at any price. That's clearly leading direction, and lo and behold, guess what happened? We moved up $100 in gold. But it's I think it's finding those nuggets, isn't it?
Yeah, speaking of nuggets, I'd be curious to get your thoughts on this. This is kind of a bit of a long-standing question Nick and I have asked since the early days of this show. It seems to have mitigated a little bit, but not a ton, which is we look at a bunch of other products. You just mentioned gold. You mentioned a bunch of other ones. They do a lot of volume in the weeklies. Certainly the equities do a lot of volumes in the weeklies. And WTI will trade short duration contracts. Like when the monthlies get down to a few days to go, they will still trade. But the weeklies, for whatever reason, never really lighted up. And I've asked a bunch of different people their thoughts on that. I'm curious, as a market maker out there, why do you think the listed weeklies, why those never really light things on fire out there?
Do you know what? It's interesting because I got asked to quote them about 5 or 6 years ago, and I kind of resisted. And it's because there's two factors as far as I'm concerned. There's so much activity in those main dates, and I think people also one of the things that happens as well is we get the LO3 and the LO5s will flag into another contract. So if we're on the set, they'll go into the OC. People don't like that. Whereas with the ES, for an example, you're sitting there as the kind of backbone of September, and everything's flooding into that, and you don't get so much cross contract roll. That's one thing. And they've never become that popular because of, again, it goes back to the fact we're very strike rich, and I think the kind of key thing is you can get what you need to get done, and you get that bend in the skew. You don't need the weekly for it, and it's just never picked up. It's just never been something, and you can see the prices into Globex. It's the same three guys pumping those prices. And you've got to cross a bit of Theo to get into it. Whereas most guys looking at kind of taking the other side feel that they can meet in the middle on the edge on the main monthly contract, and that means a lot to people that are trading fairly accurately. If something's 6 ticks wide, and Theo's at half that, you can just smidge in a little bit and someone will hit you. It seems that's the popularity of it has never really folded into the weeklies.
Yeah, and I guess I would jump in and say, because, like Adam said, him and I are always talking on the phone about the markets, and I've been learning a great deal from these guys and trying to get them to use our tools as much as they possibly can. But that's one thing, Mark, that you and I probably never mentioned was, the weeklies, as stuff comes towards expiration, you get the curve starts to get more skewed, obviously. So if you want to play, you pay in terms of a volatility level when you go into the weekly contracts as opposed to the regular monthlies that are expiring. So I guess that's a factor that we never consider. But, it's just weird. Like we talk about all the time, it's weird to me is because, like, for instance, we'll have the OPEC meetings that will have a perfect contract, and it still won't be the one that gets the most activity. So I know that they're pushing it at the exchange to try to make it more readily available. I think part of the problem, from what I've understood, is that it's a different symbol, too, because it's LO1, LO2, LO3, LO4. So unless you are very specifically asking for that symbol, sometimes you miss it. And that's kind of a recent piece of information.
Yeah, it's a big limits issue as well, as you've got to individually apply those limits from LO1 through to 5. So I know that's been an issue. We've put a few trades out on Macrohedged, and people have come back saying, I can't do that. You've got to make sure you as the 1, 2, 3, 4, and 5 are rolling, you've got to make sure you're folding into the right, especially if you're running a Theo model, you've got to make sure you're folding into the right contract. There's a little bit of complexity there that doesn't really exist in the mini. And I also think that there's a lot, there's a lot less ultra short term activity demand in oil than there is in the equity indexes. I just feel that people are quite happy with that chain structure that they've got, and then there's not so much. I mean, I speak to a lot of people, and they're in the ES minis, and they're in the 1 weeks and the 3 days expiry. They're going into an 8-day expiry. I mean, that's just how they live. We don't operate that way. We're a little bit more kind of like the beans and the corn in that sense. We don't tend to go more on the equity indexes side.
Yeah, and aren't the equity people, aren't they? You get the programs that are just selling the puts, right? So they're looking to sell the puts, and they don't really care. The sooner they expire, the better, right? So they'll put themselves out there in the weeklies, and that will be a lot of the volume. So, yeah, I mean...
And you have to remember, it's we're prime as well. So one of the big things is that we're, just talk about WTI, because, we're the prime contract, back the ES contract's leaning into the CBOE contract. So they're mapping some dates and crossing some dates there. The flip side is kind of we're the prime contract. So it's that's an issue as well for adding more dates.
It always seems like it has to be something in the nuance there, whether it's the symbols or you're right, kind of the use case. People will trade the monthlies all the way down to will they go away. But you're right, it's not quite the same beast as in the equities, where they just live in the weeklies all day long now, and the weeklies have kind of consumed that product for better and for worse.
Yeah, completely. They'd absolutely. I mean, I've got a different sound that goes off if someone hit me in the weeklies, and as well as the buzzer being slightly different, that's how rare it is, and usually get a sigh from me of, oh gosh, and it's just a pain. It's
you have a separate buzzer for when you get hit in the weeklies and WTI? Yeah, that's awesome.
Because I just need to make sure it's mapped back. It's like Nick was saying, it's a different code. If I make sure that my LO3 is correctly mapping into Oggy, is it definitely going over to all that junk needs to go on. So I have to. It happens so rare. I can. It's the only part of the business that's kind of still manual, but it's a pain.
That's actually pretty funny. That speaks volumes right there, Nick, that he has to...
Yeah, that's true. Right now, I've been talking to them about it, and I think they lament this. Like I said, they lament the symbol stuff and the fact that it's just, they've done, in CME Direct in particular, they've tied it now to the underlying so you can get a grid that just brings everything in by expiration date. So they're trying to make it more available that way. But, Adam spoke to the nuance of having to do the mappings and those kind of things and tying the proper underlying. And if you got to do it yourself in a system, then you have to really pay attention to what that expiration symbol is and stuff like that. And the thing to remember too about the weeklies and the equities, and people tend to forget this, but not all the weeklies and the equities are killing it all the time. The serial contracts are now considered weekly contracts. So I think you gotta take a step back a little bit with that and say, the regular, what is it? We're in July, like the July and August contract expirations. Those are weeklies. They got the end of months, right? So, they've been used to having those diversified expiration dates. And I just looked at the treasuries too. And the treasury weeklies, they have high volumes, but when you look at it as a percentage of the big volume numbers, it may very well be similarly, proportioned to the crude and their weeklies, because you'll have like 1.8 million available. Well, maybe it's probably less than that. You got like $1.8 million in the front contract in TY, but then the next weekly is like 190,000. So it's about 10% there. Crude's probably below that. I think if they got to the point where crude was 10% of the front weekly was 10% of the front contract, they would be ecstatic. So, but yeah, it's a question we always ask ourselves because that's the first thing we do, and especially in the stuff like gold has weeklies too, and they don't remember nothing goes on there either. It just seems crazy to me. It's I don't know.
It's weird.
It's got to be. It's something's going on. It's the symbology, or it's just people's lack of understanding or lack of knowledge that they're even there. There
are many mysteries lurking in these contracts, sir, including the mysteries of the volatility skew. And out in WTI, this has been one that's kind of been puzzling us for a while. In fact, I was talking about this when Mr. Russell Rhodes is on the show, I think last week, maybe 2 weeks ago. I lose track now. There's so many episodes going on. And we were talking kind of how surprising it was that there wasn't more of a bid in the call skew. And that really seemed to indicate that the markets were not really looking for a lot of upside, and that's kind of been borne out. Every time we've had a bit of a rally, it's kind of mitigated itself pretty quickly. Russell was tweeting earlier this week. He thought maybe the worm was turning. Said week over week, crude skew coming out. This is he's, of course, quoting here. Quick Strike had increased, showing what he says more concern about a quick move to the upside based on an increase in the possibility of an escalation of what's going on in the Middle East. And looking here, he is pretty much right. I'm looking here again, listeners, if you're playing along, this is on the TWIFO report. Go to energy and then WTI, and you'll find what we're looking at here. And you'll see that for the week here, all the action, half of the action, I should say, 52.1% coming in that SEP contract. So let's look out there, what's going on in the skew. We are seeing the calls getting, let's see the puts getting a little bit less rich to the at the money, and we're seeing the calls though getting looks like a little bit cheaper actually to the at the money. So maybe a bit of a short-lived skew bump. Is that what you're seeing out there, Nick?
Well, I'll defer to Adam on this too. After I just what I brought up, and I'll tweet this chart. I'm looking at the OC contract because I want to get outside that front contract. It's only 20 days, so I went to the OC, which is 54 days, and I put up current and then going back a week, then 2 weeks, then 3 weeks. And what you see is that we're getting some bend on the upside, but you're seeing bend on the smaller delta stuff. Okay, so you're seeing more of a general not a small bid in the vol, like in the 20s and above, but you're not seeing the bend up really until you get to the fives. But Adam knows this better than anybody, so I'll let him go from there.
All I would say is, looking at Russell's tweet, it looks there like we're seeing some decent call lift, but just got to remember on the slide there, if you look at the gap of those two prices between, I can't see what they are, but it looks like a couple of bucks of price. If you move the orange line across to the left, so the slip slide lines up, they're not really buckling that much, and I think that's something that is really, really key. That a lot of people, as these skews move along the price axis, just to make sure that you you realign them back in, because those calls are still getting crushed. Every time we rally, they're getting crushed. They're paying for guys because people are getting loaded up with puts. We've got the Mexican hedging going on at the moment. Every market mate is getting filled in on the put side. So every time we rally, we're just dumping calls, and we'll just keep suppressing that skew until we're kind of as well balanced as we can be. And irrespective of news, while all of this put buying's going on, we've got to cover that.
Has it been surprising to you guys out there in the pit that the calls can't really catch a bid, that they continue to get crushed despite the fact that we've been kind of beaten down for a while there, and there has been some, absent everything else, there has been some events in the Middle East that would make you think maybe a little bit bullish, and yet we haven't really seen the calls catch any bid. Is that kind of surprised you at all, or is that kind of what you expected seeing the flow?
Well, it's kind of when it was really surprising, and I think all the kids broke up for school here when I was away from the desk when the British vessel was taken by Iran. I thought that might have been a real trigger, and we could have kind of, again, see my mindset is I could have dumped a load more calls. And I think everyone's how much longer can this amazing U.S. growth continue? You know, the Fed's already kind of telling everybody, oh, you know, it's looking more anemic. It's going to turn, but relentlessly it keeps marching, and that's fantastic. And I think finally that kind of march out to SEP next year, people are thinking, surely that's a nice bucket to get some low as crude comes off with world demand coming off. The European Union is looking pretty dicey as far as its demand goes, whilst they're plowing ahead with their green energy programs right across Europe, which is lowering demand as well. I think people are saying, you know, there's potential like $40 WTI here, and I don't want to miss it. And that's what I'm seeing from an institutional perspective.
I'll jump in here. So, you know, all the stuff that we're talking about now, Mark, we haven't been on in a while, but we'll Macrohedged and Quick Strike, and we'll be covering this stuff in a week-long seminar coming up in August. So make sure you take a look out at Macrohedged and our tweets, mostly Macrohedged at Macrohedged on Twitter. You can find out information about that. But we'll be covering all this kind of option from basics to the more advanced skew and that kind of thing. So it's worth taking a look and seeing what the curriculum is going to be. But, you know, Adam, one other question I have just about, you know, you and I have this conversation all the time, and Mark knows that I talk about, I like, and not that and again, I always prefix everything as I'm just Nick at Quick Strike. I'm not trading. I just have a lot of pontification and ideas. I don't really do anything outside of the equity option market. But, you know, is there any, you and I always talk about ways of taking advantage of, you know, a move on the downside. Is there any way to do that outside of just doing puts, right? What other ways do you recommend that people can do that without having to go to the higher volatility puts?
Yeah, I mean, the ratio spreads are coming into play at the moment, but you don't want to be getting those too near the center because you're carrying a lot of theta. So, you know, kind of 15, 25, 1/3 ratios, they you know, even out to December, they look quite nice. You could, I mean, one of the things that you tend to find the December contracting crude always gets crushed because it's just in that kind of, well, this year being an exception. The December and January, because of the lull in that period of time, gets crushed. You know, you could pick up cheap there and look to have look to calendar spread that out to after the the driving season play, which is a nice way of getting some downside without paying a lot for it. I think that those type of strategies, you know, for me, you know, I'm from a directional perspective, I'm very I wouldn't say isolated or marginalized in my view. I'm looking at, you know, changes along the skew path that can deliver high value opportunity for very low risk. And you know, right now for me is that, you know, I think that's why I'm talking about dates that are further out. I think there's a lot of opportunity along that put path right now. You know, even if you were to kind of cost up some 45s out there and look to fund them with 25s, I think, you know, that they'll pay.
Speaking of paying, a lot of things are going on. I think people were wishing gold was paying more. We probably do the whole show on crude, but we got to hit some other products here too. So gold, I know Nick's one of other Nick's favorites, and you guys traded over there as well. Of course, the shiny stuff, aka gold, coming into today's show on the week. We're seeing it taking a bit of a breather off, not quite 1%, about 0.75%, right around 11, 12 handles or so. A lot of this comes on weakness coming in from some stronger than expected U.S. economic data, leaning on gold a little bit here. Still north of the 1,400 level, that level everyone's been watching for a while, right around 1,420, 1,421, coming in to showtime. Adam, I know you guys hang your hats in crude, but it sounds like you sling a little bit of gold there too.
Yeah, from the Macrohedged perspective, that you know, we're into our portfolio, everything sits there. So, but you know, from a gold perspective, it's quite interesting for us is that, you know, a lot of our really successful trades in 2019 have come in the shiny stuff, and that really has been just looking at just skew. You know, one of the great things with gold, you can get a lot of size done. So if you're in those skew plays, you can get a lot done. They're limited risk, And I just think so many people get overexcited. Gold overruns beautifully, like crude. You don't get so much, although it's been kind of strange this year, in the stirs and the bonds, you don't get those big overruns. There's enough supply, but you get a nice overruns in gold, which really for us, when we knew those 1450s were going to have to trade, which we did do a few days back because of just the sheer demand going through, which is, I know, Mark, you like to look at the volume on those on the weekly report, which is that was just screaming, this is going there. But for us, that skew bent out of place so much. The risk reversal was just at extreme lows on with the call demand. It was, the odds on money is to take the other side there and just get paid. And we're seeing now, gold's just come off from 1450 and it's just, it's $40 off. But not only that, we've just exacerbated the volatility crush. Everyone was just getting so bullish that we were going to 1600 and all these technical chartists everywhere. So the vol's just been absolutely crushed. So it's been a lovely trade.
Yeah, it's funny to say that, the vol crush, because for the better part of a year, right, gold vol was just nothing. It was in the toilet and kind of laying there. And then it caught a little bit of life, and you're right, everyone got excited. Okay, maybe this is it. Maybe we had questions on this very show about that. Is this a new vol regime for gold? We told everyone kind of hold their horses, and that's kind of looks like it played out that way, because anytime they catch a bid, you're right, they kind of came and just annihilated it. But Nick, I know you've always been a fan of paying the rent out there in gold land. Is that still your view, sir?
Yeah, I mean, I'm pulling up, the number of hours that Adam, you and I have talked about gold over the last, month is just insane, because we're always looking at the skew and the quick skew. And if you look at the quick skew chart right now, it's the spread on the puts are so cheap to the at the money, and the calls are still so expensive. So how I always talk about, buying the cheap option and hedging it. I mean, at this level in the future, again, I'm not exactly sure where we go from here from a future standpoint. And I know we're off, but you can start to look at those, like I talk about all the time, buying the cheap option and hedging and looking for the break even in this case, on the upside for the cheap puts. Somebody asked, I think there was a user question on that too, and still, scalping the gold. And I think gold is a good example of something that was very scalpable. And I know Adam and you had some gold on where they were scalping their deltas based on the position that they had. But yeah, it's still pretty wide. I tend to think that stuff's always going to come back. It's just a matter of how long you can hold the position, and that's something that Adam can talk to as well. Was like, what do you do if you do make that trade and you do make that play where you're gonna, you can't necessarily gold. And again, this is conversations we have, and Adam and we'll be able to explain it better. But you can't just do the risk reversal anymore, because the amount of money you got to put up for something like that. So you have to do something, where you put the risk reversal on and you hedge it. But what do you do if you are playing that skew, Adam? How long can you wait? How long can you sit on? Do you have to play with your deltas, or can you just put something on and wait for it to come back?
So it's a great question. So firstly, the quick skew piece on Quick Strike, I still am amazed on a daily basis how the entire world isn't consuming that, because it's just so much edge that people will be hunting around for, scrabbling around in the dirt for a bit of edge, and most of it's sitting there. But to answer the question, it kind of is, when I put a quick skew trade on, which are often for us, Hugh and I are often doing them. We're always talking. We love them. There's two kind of rules. One is, whilst you might get 3 or 4% extra vol going sub 30 days, I would rather go out to a 60-day contract, lose 2 or 3% in the bend of that skew to reduce the amount of hedging, because I'd rather sit in an environment that's paying me and minimize my hedging. Whereas you find that, I have the kind of, rule, sub 25 days in crude, it all gets very bendy very quickly, and you've got deltas coming out of your ears. And that's not what you want. And it's the same with any of these quick skew trades, is that for us, if you're spending all your research time on 30 days, I'll absolutely look at 60 days when I put the trade on, because it might be 5 or 10% left or right movement in the underlying that I've not got to worry about hedging. So that's the first rule we would look at. Secondly, putting them on. One of the great things about the quick skew trade is you don't have to put them on both sides. So whilst it might look beautiful to do it as a risk reversal, one of the great things is you can kind of bend in the middle using a number of different strategies like ratios or even just call spreads or put spreads out of the middle out to the deltas, which is nice. But the key thing with them is whilst they are on as a strategy, you need to consider them, and they're reacting like a risk reversal. But there are structures you need to put on that means you don't have the margin costs. And one of those is to ratio it out or put spread it out. You get the same impact, but you're not paying the crazy panic-stricken margins that a pure risk reversal would have on it. So does that answer your question?
Yeah, no, for sure. I mean, that's the thing. And just so people are a little bit clear, if you haven't listened before about the quick skew, the quick skew, the whole point of that chart is to give you an idea of if the wings are rich or cheap in comparison to the money. So obviously, if you can take advantage of it either way, as Adam was mentioning, you could take advantage of it from the wings being rich. So you would do what you would expect on the rich side, you would sell the rich side, or the wings being cheap, where you would buy the cheap side and hope for ultimately the mean reversion, right? And the twist that those guys have done with the quick skew trade is realizing that you can basically slice the vol curve at the money, and you could trade either side of it, right? So you could look for it to basically come from something that looks just like a little half cup one direction or another, an upside down cup or a cup right side up cup. So you can trade it either side.
Yeah, to give you an example of that, so on the gold was an example. So I was so petrified around these 1450s getting bought, but I was absolutely adamant when we were kind of 1360, 1370, gold was going to 1450. And Nick and Hugh are there going, we've absolutely this is the right time for the quick skew trade. It's right there. And one of the things is that kind of we settled on not putting the call side of the risk reversal on, because I was panic stricken. So we did the put side of it, because that's the great thing about the quick skew. You can just choose the side of it, and it was highly profitable. And we didn't get that upside crazy risk of having those 1450s. That was the real beauty of it, is that we knew the strategy of the bend in the skew was right, and it paid off. But we also had the flexibility within that structure to take off my fear, which was those 1450s, which is great. I mean, it's brilliant.
You mentioned earlier about the skew, and that's why we like talking gold, because the skew evolves and it swings all over the place, and that's what makes it fun compared to, let's say, a traditional equity option where the bid's always going to be to the puts, the offers to the calls. The degree is going to change, but you're always going to pretty much see that same structure. So it's kind of fun to dive into some of the commodities that can swing around and have a little bit more evolution for our audience. We talked about the vol. You guys both touched on it. The vol, not exactly loving life these days. Vol getting kind of crushed across the board. So any bid that got bid up over the last week coming in multiple points pretty much across the term structure here. Again, go into the metals portion and click on gold in the TWIFO report. You can see that for yourself. You also see that even though most of the volume, about 30% coming in the SEP contract this week, the big number one with the bullet play was upside, size upside, 1500s out there in October, going up, looks like about almost 13,000 times, big lot, 7,600 going up on Monday. 4,000 today as well, which is kind of interesting. Obviously, we don't know the full OI on today, but net slightly opening on the week, so not quite. You thought maybe they'd be giving up the ghost because we retreated from those levels, but not exactly what we're seeing out there. We also like to look, like we always do here on the show, a little bit farther out in the term structure in gold, because so much weird stuff. I'm sure, Adam, that probably comes across your radar as well. We've talked many times on this show about like you call them the gold whale, for lack of a better term. They do these crazy ratio verticals in gold. So do you spend a lot of your time looking at the far long part of the term structure as well out there in gold, Adam? Because that's where so much weirdness lives.
Yeah, that's where you see the kind of the bigger guys hedging. You start bumping into the rates guys. You start bumping into the longer dated equity guys, and that's where all they are in the absolute crazy. 1x8s, I mean, I don't I always say to Nick comes back and prices some stuff, or Hugh, or we don't auto quote that stuff. Anything above a 1x4, when the RFQ comes in, I need to hear about it. I think I got burnt, back in 2010 or something, with somebody doing a 1x20, which I auto quoted, and I regretted that. So
that'll leave a mark.
All of that stuff you start bumping into a lot of money in that end of the curve, and it needs a lot of time thinking about how you're going to price that back.
And just one more, just to kind of get us toward this, I don't know if a conclusion in the gold, but I just pulled up a 3-year chart. So basically, what we have in Quick Strike and what will be coming sometime this year, I'm not sure, and Adam has seen it, he can attest to it. We have the ability, we don't know what we're going to call it yet, but we can plot like the different metrics for the volatility on a chart, and it looks sort of like a DNA plot, like, a 23andMe or a Ancestry.com. And so you can kind of see what the DNA of the volatility looks like. And it's actually super cool. But one thing...
Has Mark not seen that yet?
Mark has not seen that yet. No, that's been a very close to the vest chart. So, we're getting closer to having it where... Adam, I didn't even show you yet. We have like these individualized product level versions, so it'll just kind of show like a EKG for that particular product, however you want to call it. I'm calling all these names. I'm calling it Quick DNA right now, so because it looks sort of like like mapping the DNA matrix. But if in any case, I'm looking at Adam mentioned the 60-day gold as opposed to the 30 because you get more time for the reversion to take place. And I'm looking at the constant maturity 30 and 60-day. In Quick Skew, and I will tweet this one, and I'm looking at the 25 Delta Quick Skew, and the 60-day is actually a wider channel, Quick Skew channel, than the 30-day. So, and that's over the course of the last 3 years, it's the widest it's been, and on the 2-year, it's into the third standard deviation, third standard deviation away from the mean. But right now, and you guys will see. This is an interesting picture, so potentially some opportunity there as well. And then, as like a little bit of a teaser, as we like to try to do, very soon, you say, Nick, you talk about these 30 days and these 60 days. Very soon, you'll be able to ask Quick Strike to tell you what contract I should use for a 60-day or a 30-day, because you'll be able to go in and type something and say, give me something that's close to 60 days and give me the risk reversal strikes, and it's going to tell you what you should be doing. So Adam has seen that as well. He's sort of our guinea pig for all the stuff that we're trying to do. There's stuff going on here in gold, and people should pay attention to it if you have the opportunity to look at these charts. And I think there's some interesting stuff there.
Stuff going on indeed. So I look forward to seeing all of that. You've been doing your curmudgeon tour, so you haven't been coming around as much. I don't get to see all the cool new stuff first anymore.
Yeah.
We'll have to.
I was on my Australian vacation. That's how I like to think about it. So
I call it the worldwide curmudgeon tour. To each their own. Tomatoes. But speaking of, before we get off it really quickly, hopefully you didn't get caught on this one, Adam. Looks like our ratio friend was back here in Dees 2020 looks like another fly. Looks like the 15.5, 18.5, 22.5. So you got a little wider, a little more exotic on the upper leg there. 1,500 by 3,000 by 1,500 times. Again, this is in the Dees 2020 here in gold, listeners. So another week, another funky fly in the far off upside, Adam. Sounds like yet another normal week for gold, right?
Yeah, this is happening more and more and more, and it's good that you're spotting these, because these are the things that people that they miss, and this is the stuff that dictates direction over the term. Not a lot of people kind of sometimes got their face very close to the coal face, and it's these kind of trades that are dictating where we're going, and I think that's a key thing that you spend the time looking at these.
We could probably spend a whole show just on funky upside ratios in gold. There's enough weirdness that lives in that part of the skew and that part of the term structure to fill many shows. But we're kind of come up against. I want to make sure we get the listeners on too. We got time for one more product. I'll be charitable. I'll let you guys choose. Where do you guys want to go next?
Oh gosh. I don't know. Should we nod to the Eurodollars just a little bit, since we have FOMC meeting next week and it looks like something's priced in? Should we talk about that a little bit?
Yeah,
maybe?
Okay, we can go to that then. Let's pull up here, listeners. Of course, head on over to the rates, and then hit on Eurodollar. Kind of hard to miss. It does all the volume in the room. So it's the volume numbers on Eurodollar, it's still hard to process for anyone who's used to any other products out there. And you come to the Euros, and it's like, whoa, what a beast it is out here. Speaking of FOMC, Nick, kind of interesting. Draghi's comments kind of spooking the market a little bit today, yet looks like the quick strike, or it should be the quick strike, the Fed watch kind of unched from where it was a week ago, right? A little bit more of a probability for the 25% basis point cut, and the 50 basis point cut kind of unched. Does that surprise you?
Yeah, this thing has been, if you've paid attention when the market was going a little bit crazy, this thing has gone from, it has been all over the place. Like, there was a period of time where it looked like there was definitely going to be a 50-point move, and then it switched back and forth. So it's really, really sensitive. And somebody asked a question in the notes about how is this done, and I put the link for the probability tree. Mark, if you want to tweet that or put that as part of the show notes, because basically what's happening is they're looking at the contract before and after the FOMC meetings, and then doing a probability tree to determine what, and with the premise that there's going to be a 25 bip move one way or another. Okay, and that's kind of how. And for me to say any more in words would only be embarrassing to myself, because you got to read the paper, and we programmed it a long time ago. But I think, and Adam and I and Hugh, we've been talking about this quite a bit, because it feels like, the Eurodollars is a funny product because it's just not the same. And if you paid attention to that market, there are groups in the pit that had to leave because the skew just didn't act like skew regularly does, right? Because we could talk about skew, and you talk about gold moving back and forth and stuff like that, but the Eurodollar one is just not the same. So does it surprise me? I still can't believe that there would be even thoughts of a 50%, a 50 basis point cut, but there's probabilities in there. I think we might see it move towards a quarter, and I would expect even possibly to show some unch in there. But it's a market. Even though I traded it, sometimes it's just really hard to, I just don't know. There's so many long-term plays in there. There's so much sort of lemming play in there when you get somebody doing something. We had a period of time where I had all the brokers calling me. Everybody wanted to price these equidistant, around the money risk reversals hedged at the money. Everybody was asking the same thing because they wanted to look at a balanced way of determining where the call skew was, because everybody was saying, I want any opportunity I can to buy call skew for zero. I want to be able to pay 0 ticks. I want to, right? So now, easy way to do that is you just kind of look and see what the volatilities look like, but they wanted to see it in ticks. So we built a special tool for them, and again, to kind of shout out to what's coming, you'll be able to actually ask for that specific trade from Quick Strike in like less than 10 characters. It'll be really kind of cool. But Adam's been looking at the Eurodollars a little bit more, and this is something I wanted to ask out loud too. It's like, first of all, Adam can attest with all his experience, it just doesn't act like a commodity product. And secondly, it's like, Adam, I wanted to ask, when you started to look at what are the things, Eurodollars aside, just in general, when you come into the market, what is your kind of order of attack? And you can use Eurodollars as maybe, what's your order of attack to see what are you looking for when you start to look at a new product or a new product group?
So regarding just on the Eurodollar stuff, I think it's a completely different beast. I've never known anything like it. The way they attack a strike and just crush it, they don't trade the skew. You're right, Nick. It's strange. Things don't come back in that usual way. It seems to be people are hunting for bargains or 0 tick plays, and the skew can be bent out for forever. It doesn't really matter. That strikes today's target. It's kind of like, schoolyard bullying. Like that strike gets it for the next week, and everyone wades into it, and then they move on again. And it's really like opposing parallel worlds to commodities or even indices. But to kind of answer the question of if we were going to go into that from a making perspective, I go through kind of a base checklist of things. Is the CME the lead on it, or is there something I can lean on? Clearly with with some assets, you've got other exchanges that you can lean on as well. Others are less so. Strike distances. One of the things that I've personally really struggled with is you've got to spread 3 strikes to kind of get your 20 deltas with the euro dollars. Kind of completely alien to someone doing commodities that's got a lot, well, apart from trading out gas, but someone's got a lot more strike range. How much mass quote availability is there from the Merc? So, stuff that's really, really busy, that's got a lot of people wanting to pump into it, like the 10-year and things like that, is that there's a bit of a waiting list for your mass quote ID. What are the matching rules? Is it FIFO? How much are the LMMs getting as a percentage cut? How much demand's coming out of blocks, clear ports? And how many people are you up against on what I call join? So in Eurodollars, I've never looked to market make Eurodollars, but I can already see how the depth of market ladder works, that it's all join play. So one of the things that I really don't like about crude anymore is there's more and more market join plays. And what I mean by that is people that are not operating what I would call a theoretical pricing model. So I operate a micro pricing model on top of a theoretical model, and I will price the skew. And if I move up a tick, they all follow. And if I move down a tick, they all pull their bids. And so market join as a function, certainly sub 20 delta, has become a massive game that everyone's playing. And you don't need a theoretical model. You're just playing join all the time. And as soon as there's less than 100 lots of liquidity, you all pull. So that's a factor as whether or not I'd be kind of their kind of market making mindsets to be involved in it. If you're looking for directional plays or skew plays, making sure there's liquidity is the key thing, and the rest of it, you're in the mix.
That's kind of scary from a market making perspective. You don't need a model; you just hit and join all the time. That could take you to some dark places very quickly.
Yeah. Join's scary. I know people out there that just don't operate a Theo model. They've got boundary sets that'll have a Theo model that sits around it, that they're not kind of 0.7 of a tick closer to the electric fence than they need to be. But 9 times out of 10, they're looking at the join play, and that's great. It's great for one of the beauties of the volume that the Mercs is generating is that the users consuming that are getting amazing prices. But edge is eroded for pure edge players. But they want to take part in 20,000 lots a day, and they want 0.3 of a tick out of that, and that's their game, and that's fine. But that's providing that these guys will be there, and you can hit those prices, so it's all real. There's a join has been a thing in crude that I've noticed over the last few years is way more prevalent than it ever was.
I had no idea that they had a join thing. That's insane.
Yeah. It's just if I'm 2023 and I go 21 bid, you literally just go boink, and then they all just join up, because as long as I've gone 21 bid for 50 or more, they'll just jump on that. They're not doing it in 50, 40 deltas. Those guys don't get involved in that. They're out there 20 delta subs, and they just want to be part of that. That's how they operate.
Crazy,
fascinating, and/or terrifying. I lean a little bit more towards the latter. Sounds like you do as well. Nick, we got to keep rolling really quickly. I want to ask you before we get to the listeners really quickly. I'm just curious, Adam. You guys interact with a lot of the bleeding edge of the futures options retail over there at Macrohedged. Is Eurodollar a product that can get any traction with those guys? I mean, it's such a bear to come to grips with, as you kind of just mentioned.
That's I'm really glad you asked that question. That's a great question. Most people, we've got a few people, customers that are come to us, and that's what they're really interested in. They're rate specialists, but you do tend to find if you put a trade out, if we put something out, I don't know, in gold, you literally see all the flow hitting that strategy, and there'll be hundreds go through. If we put one out in the Eurodollars, very few. And I think it's a combination of people find it's feedback we've had too slow and boring, or my account's too small to benefit from those type of strategies, or the other one is I don't understand it, and what's the difference to the 10 years? And that's the range of the retail mindsets going on. But that's a cracking question, because we see the least take-up of people when we put a euro-dollar trade out versus something like gold or something like corn that everyone just floods into.
Well, speaking of cracking questions, let's hope you guys have some in store for us, a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, let's get to your questions. Let's see how many we can bang out here. You kind of touched on this before, Nick. This is people missed you, obviously. They're asking a lot of Nick questions today. Shut DL wants to know, are you still scalping your gold gamma? Your old favorite trade, Nick. You paying the rent. You still paying the rent?
Yeah. See, I always feel bad talking about it, especially when a guy like Adam's on, because I just talk to him about stuff and he actually does stuff. But I think that trade's there. And in fact, we have another tool that Adam has seen as well, which we call quick hedge or quick edge. We're not quite sure, which kind of shows you where some of the cheap ways to do things are. So all those tools will be making their way out there. I like that market because, as we've said, it traded from $13.50 to $14.50, and in the interim, it probably had $20 to $25 ranges. So there's definitely stuff you can do there if you're paying attention. And there's cheap stuff. There's cheap options. So am I scalping it? Yeah, I'm scalping it in the equivalent of my mental notes and in my conversations with Adam and Hugh about stuff and talking about trades to put out for things. But I still always like it. I like that in any, like we just talking about the Eurodollars, and I think the decent March puts are super cheap. The 5 and 10 delta puts in the Eurodollars are super cheap, and you don't buy them to buy them outright. I think you buy them to hedge them. I think that trade's been there all along. It's paid off 3 or 4 times in the last 3 months, just based on the ball getting annihilated and then the market moving. So that's how this. Adam mentioned one thing, and again, I'm elaborating from gold to the other one. It's just the stuff sits around, and it can only sit around for so long. So if you have the wherewithal, or your timing is good, or you're paying attention, there's opportunity there. So yes, I think there's opportunity to scalp the gamma and gold. I think there will be, in this sort of uncertainty that we have just in general with the U.S. economy and tensions and all that kind of stuff.
All right, well said, sir. Let's get this. WTI Skew has been the theme of the day. Got a bunch of comments and questions on this. Crypto Messi coming, I think, even during the show. I think he was commenting on what we were talking about with Russell's chart, showing the move there, and he wants to know, is that kind of useful for directional trading? This is kind of a question we get a lot. We touched on it before. The skew, when we talk about it, it kind of shows you some longer-term trends lining up in the paper flow. But I think what a guy like Crypto Messi and a lot of people are out there looking for, particularly on the future side, they're scalping tick to tick, and they want to know if the option skew is a useful indicator for that sort of intraday type scalping. Adam, you must have a lot of guys coming at you with this kind of question. What do you say for something like WTI skew being useful for kind of very short-term intraday directional type trading?
I would say, I'm going to say no. It's the easiest answer, so people don't waste any dollars chasing that immediately. One of the things that is a worthwhile strategy that people should look at, I know a couple, Nick and I know a couple of guys very successful in the equity options, on the equity index options, that are looking at as the intraday along the skew path as when you're seeing compression and you're seeing a suppressed, say, 25 to 35 delta suppression. Then you see the 10 delta compress into that very, very short period of time. It spots turns but it tends to happen, Crude, not so much, but you could get away with it on the mini. You could get away with it potentially if there's enough volume going through in the currencies. But you've got to be zoomed in a lot, and it does work. But what happens is, a really good example is, if anyone's got look at the quick skew view, you'll see crude over the last, let's see, if you look at a year's view, you'll see some periods of time when you've just got a totally flat line. And if you map that over, I'll post it on Macrohedged. You've got you'll see that peak, the peak of crude. So the low of crude in end of 2018, beginning of 2019 in a sell-off, and the peak at the end of April was defined by the suppression of those two things. Well, that's actually happening all day throughout the day, and it's just making sure you've got enough readings going on a minute-by-minute basis to take that. So the kind of quick answer is, if you don't have a massive setup, might be too costly. If you have got a fairly large setup, you probably know the answer to this already, is you can make some good dollar throughout the day doing it.
There you go. Well said. Yeah, we get this question all the time. People want to be able to sling tick by tick using the options view. Yeah. It's not really what it was designed for. I wish, longer term trends, like we've illuminated before, the calls being weak, that's something to pay attention to. Longer term, but yeah, minute by minute. Looks like other listeners chiming in. Trader 1906, he's over 100 years old. He's an old fellow. So welcome. I'm glad you can still listen and master the internet to stream. He kind of chimes in and says, won't give you buy or sell signals, so he agrees. He said he's modeled some skew bends, let you know how moves are overdone, similar to gold, but it's no holy grail. Yeah, pretty much. That's kind of in line with what we were just saying. Let's see. I'll save the Russell stuff for when Sean's back. Azarafel, I don't know. One of those two. He wants to know, here's a good one. You probably get this on a daily basis, Adam, as well. What is the best commodity market for options traders right now? Best mix of volume, volatility, and liquidity. Also wants to know, when's Nick coming? Well, this is freaking Nick love. What's going on? See, Nick could go away for a few weeks, and they miss their beloved curmudgeon.
People love my dry sense of humor, I think, is what it is. So that's what they're missing.
It's like the popularity of BBC shows. They're kind of uncomfortable. You don't really get why people like them. They're kind of dry. But, hey, it works, right? And
that's right. I'll take it.
You're like a obscure BBC show after hours on PBS for us here.
Faulty Towers, right? That's what I like.
There we go. But yeah, Adam, this is kind of a good question. I'm gonna go out on a limb and say you're probably leaning maybe. He says outside of obviously the equity options, which are probably the first blush for a lot of people. So I'm gonna guess maybe you like WTI. You got something else up your sleeve.
Yeah, I mean, I'll say WTI, but look. Anything that's moving around a little bit, and anything where the vega is high enough that if you are shorting it, it's worth getting paid for. I mean, I can't imagine anything worse than trading FX options. That's just a personal view. You just slowly bled out theta. Corn, beans, crude, gas, anything where there's there's big volume in these things. The Merck's got a fantastic, amount of volume that is hitting all of these products, and there's plenty of vega around that you can capitalize on. Even if you want to get kind of a bit more, if you want to get into the FX side as well, something that we map a lot of is we price all the energy stuff into different currencies and then reblend them over the top. So you can if you're looking at a weakening sterling, you might want to play crude sterling, crude price to sterling, and trade an option there that gives you, double payout.
Well said, sir. Unfortunately, that music means we've come to the end. We've already run a little long, listeners. We had to squeeze a few more of you in there just to make sure you guys got your love on the show. So speaking of love, really quickly, this last question here, Nick. You kind of touched on it already. Dasney. They want to know explain how the FedWatch tool actually works. You said you already tweeted out a chart, right? So, or a diagram. So we'll retweet that for you. You can look at Nick's diagram for how the FedWatch actually works. Is that correct?
No, you tweet. I put the link in the show notes, so you can. I put the link in the doc, so you could add it to the show notes.
Oh, okay, all right. We'll put that out there for you. Okay, perfect. So Dasney, we will put that out there.
Yeah,
we will put that out there for you, Dasney, so you too can see how the magic that is the FedWatch tool. It is pretty interesting stuff. If you're looking at these markets, you're not using the FedWatch Shame on you. You should be. At the very least, it's a good indicator. But let's go back around the horn. Adam, you're our guest, so we'll start with you. We'll give you pride of place. If folks like what you're talking about here, gold skew, WTI skew, maybe a little bit of euro-dollar fund, all that good stuff, they want to learn more, maybe try out your services for themselves, where should they go? What should they do, sir?
First of all, go to macrohedged.com or on Twitter, it's at Macrohedged. And if they're not doing anything on the week of the 26th of August, we are doing a week-long training course. And, you could be there reading thousands and thousands of pages of books, all irrelevant, and we're going through what's relevant, how you're going to make money. And our objective of doing it is to try and get, a community of people that are trained to have these conversations that we've been having today, and we can get, more and more people having detailed conversations about options on futures.
There you go. At Macrohedged on the old Twitter machine is one of the best places to go. They put out good charts and things intraday and throughout the week. Maybe you can get back and forth on one of these little chats that he and Nick have going about all sorts of esoteric products. Speaking of esoteric products, Nick, you got a lot of cool new stuff out there. First off, when am I going to see it? And then B, if folks want to go kick the tires for themselves, where should they go? What should they do?
Well, it's in Dev, so you always got your secret link into Dev, right? So you can always I can show you some stuff there when we get the chance.
Link, yes.
You have your secret link in the Dev. No, so we'll be doing a limited release of what we're calling Ask QS this weekend. So that won't be for everyone quite yet, but what we're really trying to do there is give people the ability to price things up really quickly. And also, just we've learned over just with all the feedback that we're getting, we just need to make things a little bit more straightforward for people to find it. We flattened it out, but we have so much information, we're going to try to make it so you can just sort of verbally ask for things and they'll be served up to you. So look for that to be becoming near term. And then the other thing to pay attention to is we've been working with the CME, obviously, and we'll be having a limited release of alerts. So you'll be able to get at-the-money volatility alerts like highs and lows or standard deviation ranges over a 2-year period of time, as well as new highs in open interest volume and put-call ratio. So that'll be coming very soon once the CME gets infrastructure in place to collect the users that want to see those alerts. You'll be getting those alerts from us. And then there's all kinds of good things that we'll have, like I mentioned, the quick DNA, the quick hedge, the quick alerts, and then the Ask QS. Those are all coming very shortly. But, tweet at us if you'd like to see some samples. We'll put some stuff out. And once you learn the language, and I think Adam can attest to this, once you learn the language, and we'll talk about it in the class too, you'll be able to do some things that just are going to be lightning quick. You'll be super, super excited. I think you'll be super excited about it.
There you go. Check it out. BANTIX.com, BANTIX.com, or to search for QuickStrike, QUIKSTRIKE is the place to go. Give them a follow on the Twitter machine while you're at it as well, at QuickStrike1. Remember, no C. QuickStrike1. A lot of good data coming out there throughout the week. I can attest to that as well. We retweet a lot of that for you over there. At Options, of course, is the place to find us on the Twitter. And, of course, if you're listening live, you want to check out more, theoptionsinsider.com is the mothership from whence all of our content flows. You got the shows there. You've got all the articles, all the good stuff, our tweets, our social medias, all that good stuff over there. Of course, subscribe to the Options Insider Network if you haven't done so already on your provider of choice to get not just TWIFO, but all the other dozen-plus programs we do here on this fun network. We will keep you busy with options content at the very least. I promise you that. And on behalf of Adam and Nick and our friends over there at CME and Sean, who couldn't be here today, and indeed myself, I want to thank all of you out there for downloading, streaming, and subscribing, and for sending in such great questions. Keep them coming, and we'll see you back here next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at BANTIX.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications.